the way halvings work is the fair value increases. So we've got a tailwind that the fair value today, based on Metcalfe's law model that Tim Peterson runs and that I think is fantastic, says that the fair value is somewhere in the low 50s, 52, 53, let's just call it 50. At the halving, fair value doubles. What do you mean, Mark? What are you talking about? Well, think about it. The miners who secure the network, their costs are fixed, mining machines and electricity. So if their block rewards, the number of rewards that they're paid to secure the network, gets cut in half, and the price doesn't move, then they're out of business. So there's a built-in mechanism to move the price higher, which is actually really interesting because that attracts attention because there's movement. Fair value, every halving has added a zero. So we went from 100 to 1,000. Then we went from 1,000 to 10,000. Now we go from 10,000 to 100,000. So if fair value is 100,000 and we're trading at 26, it's a pretty rapid increase to fair value, I think, as investors buy things that are below fair value. But then what happens in the fall, post-halving, you get this parabolic blow off top. And in the previous cycle, fair value was around 30K. We got all the way to 69. That was because there was too much leverage and too much gambling and speculating. I don't think we go 2x this time or 2.5x this time. Could we get 1.5x? Sure. And that gives about 150K, something like that. This is a truly unique diversifying asset that must be in everyone's portfolio. It should be at least 1%. I'll argue 2 or 3%, but 1%'s fine. And had you done that a decade ago, okay, had you taken 1%, half from stocks, half from bonds, 1%, your portfolio would have done two things. It would have compounded at about 250 basis points per year better with less volatility. So it reduces risk and adds return. It's the perfect diversifying asset because it's 0.0 correlated to bonds and 0.15 correlated to stocks. And look, Markowitz won the Nobel Prize for a reason. CAPM works. When you add diversifying assets with reasonable levels of volatility or even high levels of volatility, if they're highly uncorrelated, your portfolio becomes more efficient. And so as a fiduciary, you can't not have this asset, particularly if now there's a ETF by a trusted brand. Retail, many of them have abdicated that day-to-day responsibility to their financial advisor in a good way, right? Most people shouldn't manage their own money. I don't mean it's a bad thing. It's just that's not their specialty, right? That's not your day-to-day thing. And it didn't used to be that way, right? In the good old days, you worked for a company and you had a pension and they had a professional manager that took care of the money. And you got a defined benefit for the rest of your life. And then they snookered us by saying, hey, we're going to change the rules and we're going to make it portable and defined contribution. Well, that was just a gift to corporations because they had to spend 30% less to fund their obligation, went straight to their bottom line and into the manager's pockets, and they thrust that responsibility on the individual. The average individual doesn't spend the time or have the knowledge to manage their portfolio. It's not a criticism. I am a financial manager. I take care of people's assets. So I do think that the average investor will be very well served by having a good RIA, registered investment advisor, good financial advisor, who will say, I gotta put 1%.
Let's go that direction.
And again, that's not even a big number. If we got 2 or 3%, Katie bar the door. I'm probably wrong that it will only be Blackrock. Because, how do you, with a straight face, approve Blackrock and not approve Franklin Templeton or Fidelity? Like you could say, well, I don't want to approve Bitwise or I don't want to approve 21 Shares because, they're crypto people. They're not traditional. They probably understand, not probably, I know, they understand this business better than the TradFi people. Not the TradFi people haven't hired good people and are smart. Actually, the Fidelity team understands as well as anybody, and they're amazing. The others, I don't know what kind of resources they have, but I know the quality at 21 shares. I know the quality at Bitwise, high quality. Well, to not approve them and approve the Johnny-come-latelys who weren't there at the beginning, who weren't there on the pioneering phase, I think is just blatant corruptionism. The way, but that, look, we know that's how it works. Think about all the people who've applied for ETFs. No one that I'm aware of, and I'm probably wrong, but no one that I'm aware of, other than Blackrock, has gotten 99.99% of their applications approved.
Yeah, exactly.
Blackrock,
Yeah,
it's 756 applications. They've been denied once. I believe, and I've said multiple times, that Blackrock will be the first one. I've actually been saying that for over a year. I actually might even go stronger and say they'll be the only one approved. Okay. No, that'll never happen. That would be too much, corruption. Like, well, I'm just saying it's certainly possible. What's probably more likely is BlackRock first, and then a gap, and then some number of others. But the thing is, whoever's first is going to get the vast majority of assets. Gold ETF is an example with GLD. You had the Bitcoin futures ETF with Bitto getting 98%, and then a couple others getting like 1% each. So look, that's just my belief, and I believe it's who you know in this game, not what you know. There are a lot of people who should have gotten approved, right? The Winklevoss twins were the first to apply. They should have gotten approved. There was no reason not to approve it, other than, again, kind of the way the game is played, and the people in charge want to be in charge. So, as much as I would love it, again, portfolio company, full disclosure, I would love for them to get approved. I just don't think it's going to happen. I don't think they'll be denied. I just think they'll be pushed. I think they could approve on the 17th, but I don't think they will. I think they'll push it into next year. So you push 90 days, that gets you into January. You could push again then into March, April, but that's it. Then you have to